Ever heard the one about a controller walking into a bar with a mini CFO cape? Yeah, it's as funny as it sounds, but here's the kicker. Do people really think controllers are tiny CFO sidekicks? Hold on to your calculators, because we're diving into the world of numbers and job titles. Is being a controller your secret ticket to becoming a full-fledged CFO? Or is it more like hoping your bicycle turns into a Ferrari? Let's talk cash. We're spilling the beans on what these finance folks rake in. And trust me, it's not pocket change. But what exactly do these money magicians do all day? Think unraveling past mysteries versus predicting financial futures. We'll decode the real deal behind their roles. So, whether you're a numbers enthusiast or just looking for some financial gossip, hit that play button and let's uncover the thrilling showdown of controller versus CFO. Becoming a CFO, Chief Financial Officer, is a fantastic goal for those in finance. This role involves sitting with a top team and making choices that affect the whole company. Now, comparing a controller and a CFO, the easiest way to understand the difference is that a controller is like an accountant, while a CFO is a more advanced financial analyst. In simple terms, a controller deals with numbers from the past, while a CFO looks ahead to the future. Now, let's talk money. Looking at earning potential, a CFO in New York City on average earns around $200,000 a year as a base salary. But with bonuses and equity, this can go up to $350,000. On the other hand, a controller's base salary is about $120,000 a year on average, reaching around $200,000 with bonuses and equity. Remember, these are just averages and actual pay can differ by $50,000 to $100,000 depending on the company size. The term controller comes from the idea that this person manages the budget and keeps track of the business's financial records. A controller, like themselves, focuses on the past and present, while a CFO thinks more about the future. But what does it mean when they say they're always focused on the past and the present? Well, as a controller, they go through daily and monthly routines, looking at transactions that happened in the past. This helps ensure that these transactions are correctly shown on financial statements. And when they talk about looking at the present, it involves handling the everyday money operations of the business, like billing, paying bills, and managing payroll. On the flip side, a CFO is more interested in what's coming down the road. They spend most of their time checking budgets and using models to predict future financial situations. Of course, they do spend some time on the current money matters of the business, but their attention is usually 90% on the future and 10% on the present. It's not as clear-cut as just two sides though. A controller also dedicates a bit of time to examining budgets and forecasts for what lies ahead. Alright, let's dive into the business world's version of a storybook, the business cycle, and see how controllers and CFOs play their roles. Imagine a business just starting out, like a seedling sprouting. In these early days, things are pretty quiet. There's no need for a controller or a CFO because there isn't much going on. The founders can handle things themselves, jotting down every detail in Excel or simply bookkeeping tools like QuickBooks. But as this startup grows and looks for its first real boost, often called seed funding, things change. Suddenly, they realize the books need tidying up. This is when they might hire an outside accounting firm to help keep track of everything. And as the business starts making waves and eyes a bigger funding round, often called Series A, the pressure's on to have clean financial statements that fit the rules, like US GAAP or local standards. That's when a light bulb goes off. The business needs a financial superhero. Enter the controller. They're like the first responders of finance, making sure everything is in line. This often marks the first official accounting hire. As time goes on and the company keeps growing, usually around the time it has over 20 employees, the controller takes center stage. They start building a team of financial wizards. Think of them like the Avengers of accounting, a staff accountant for managing money going out, accounts payable, and another for money coming in, billing or accounts receivable. This setup usually sails smoothly for a few years until the company reaches about 100 people. By then, it's not a baby anymore. It's growing up and catching the attention of investors. It's like getting ready for another exciting chapter, another funding round just around the corner. Until this point, the controller has been handling many of the finance-related tasks that the company needs. They're the ones creating the budget and ensuring the company sticks to it. The controller also takes care of keeping the books and records in line with local accounting standards. However, at this stage, relying solely on a controller as the finance head might not cut it anymore. The company's founders started considering the possibility of hiring a CFO. It becomes clear that the company needs a couple of critical things. First off, there's a need for serious planning. We're talking about big-time planning here. This means planning for things like launching new products, gearing up for future fundraising events, and figuring out how many people the company needs and where to put them. Another reason the company requires a CFO at this point is that they need someone who can communicate with investors. You might wonder, why can't the controller do that? Well, they can do some extent, but a CFO is better suited for investor talks because they can handle matters that a controller might not be equipped for. We're talking about things like sales planning, plotting out product strategies, and understanding the company's current and potential financial obligations. When it comes to education, both controllers and CFOs usually have bachelor's degrees in fields like accounting, finance, economics, or business administration. For controllers, their focus is often on accounting. However, having a master's degree helps a lot, especially if you're aiming for a CFO role. An MBA, Master of Business Administration, or another relevant master's degree is highly valuable. Certifications also come into play. Controllers are usually CPAs, while CFOs might be CPAs, Certified Management Accountants, or Chartered Financial Analysts. Speaking of certifications, if you're eyeing the role of a controller, going for the CPA certification is the right move. And if you're gunning for the CFO spot, the path involves getting your MBA and then taking the CFA exam. And here's a nifty way to see the difference between controllers and CFOs. Controllers often come from a background in public accounting, while CFOs usually step out of financial planning and analysis. And about that question of whether you can use a controller role as a stepping stone to a CFO gig, well, it's a bit like finding a rare gem in a treasure hunt. Roughly 10% of CFOs have controller roots. So if you're dreaming of that CFO title, focus on finance. Get that MBA and clock in 5 to 7 years mastering the art of financial planning and analysis. This formula works like magic in any scenario. Now, let's breeze through the tasks that fall under a controller's job. Picture this: closing the books, sorting out records, and getting those financial statements ready to roll. On top of that, they're the masters of accounts payable and receivable, plus the all-important payroll duties. Keeping a watchful eye on the budget and making sure the company dances to the tune of its yearly budget? Yep, that's their gig. And hey, they also play ringmaster to the external audit and make sure the company bows to the local tax rules. Now, let's pivot and explore the daily activities of a CFO. They craft a visionary 5-year plan, a roadmap to achieve distant milestones. Digging deeper, they endorse the monthly financial package that keeps investors informed. Collaborating with the controller, they harmonize investor reporting and regulatory compliance. But that's not all. They act as the quarterback of the business, ensuring the sales team attains its goals, and they orchestrate the product team to unleash new offerings strategically. Additionally, they serve as the custodians of forecasting models within the FP&A team, maintaining accuracy. As always, if you're left scratching your head or if you've got a light bulb moment, pop your thoughts in the comments below. And if this video sparked some serious aha moments, don't keep them to yourself. Share the knowledge with friends and colleagues. Until next time, keep those financial gears turning.